Welcome to This Week in Money. I'm Jim Goddard. Today, John Mauldin of Mauldin Economics believes the longer quantitative easing lasts, the more severe the next economic downturn will be. Kaiser research founder John Kaiser is worried Canada's venture exchange will slide to the side. We'll talk to John Mauldin right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is John Mauldin, chairman of Mauldin Economics. Welcome to the show, John.
It's good to be here, sir. Thank you.
I read your article. It's called Bubbles Everywhere. It's not about a water leak in a soap factory. We're talking about unsustained growth in so many areas, whether it's real estate, car loans, and you said the biggest, most dangerous bubble right now is government.
Yes. What we have is central banks everywhere inflating their money supply. So it's showing up in assets, that, as in stock markets, it's not showing up in inflation in prices. So we have this odd situation where headline inflation, what we think of as inflation, is actually fairly low, both in the United States and especially in Europe and Japan. They were in outright deflation over the last 20 years, a little inflation here and there, but not much. But we've seen the money that they're printing is flowing into assets. So it's kind of a perverse situation. You have the elites here complaining about the divide between the rich and the poor, the 1% and the 99%. Well, what are they doing? They're inflating the assets of the rich. We're seeing real estate go up. We're doing that by design. They are hoping that they can make the stock market of trickle-down monetary policy. The very economists who poo-pooed the idea of trickle-down supply-side economics then turn around and do the same thing with monetary policy. So who are the two groups that benefit the most from inflating assets? Banks and wealthy, because they're the ones with the assets. It's a rather odd thing. And so that money is showing up in all sorts of odd places. It's showing up in emerging markets. It's showing up in different trade policies. That's why you see the government of Singapore, the Central Bank of Singapore, asking the Central Bank of the U.S. to not stop QE because they're worried that it's going to affect their terms of trade. They're worried that it's going to affect the value of their currency and their stock markets. We have a world turned upside down. In essence, what we have, sir, is in 2008, 2009, we had a patient go, it was in a car wreck. They came in, we brought them into the hospital, and we put them on morphine while we were trying to repair the damage. But rather than getting them off the morphine as soon as possible and back up and walking on their own, we continued to give them morphine. And now our economy is hooked on this drug of quantitative easing. So even to the point where Ben Bernanke last May and June can say, well, we're thinking about tapering. Now, what he was talking about is maybe reducing the amount of the growth of their balance sheet. Not reducing their balance sheet, reducing the growth of the balance sheet. We have a $4 trillion balance sheet, and the market just throws up over the idea of not having an extra $10 billion come in every month, instead, getting $75 billion rather than $85 billion. And that shows you the amount of addiction. And it's like most addictions, it's a psychological thing. It'll have a physical result too. But we need to get over it. We need to be able to stand up and walk on our own and stop this perverse concept of a group of men sitting in, 4 central banks of the world feeling that they can micromanage the cycles of the economy. We're going to have business cycles. We're going to have recessions. That's part of the ebb and flow of commerce. That is not the responsibility of central banks to try to micromanage every bit of volatility out of the market. Because what it does by worrying about volatility, it builds up the imbalances. And so that when you do have a market reaction, it's far worse than it would have been if you had just let it to have small disturbances along the way. Now we've got a academic ethic a theory, a neo-Keynesian world, where they feel they're responsible for prices. They feel they're responsible, that other mandate that we have in the Fed is for employment. And now Ben Bernanke has basically added a third mandate. He said, we're responsible for the stock market. We're thinking about how we can boost prices of the stock market. And that shouldn't be the responsibility of central banks. So,
wasn't this the downfall?
It's creating bubbles everywhere, and it's creating potential instability.
John, isn't this what caused the downfall of the Soviet Union? Because they tried to control every asset of life. After a while, it just became unsustainable, and they collapsed. Are we looking at the same kind of thing here?
No, I mean we're nowhere near that kind of control. But philosophically, it's part of the same mistake. We're not looking at a collapse like Soviet Union or Argentina, but we could certainly have another 2008, 2009 market reaction. Now it will be different. We're not going to repeat 2009. That's because crises don't tend to repeat themselves in the short term. We've now, for instance, we've shored up our banks in the U.S. and in England. We're not going to have that credit crisis that we had the last time. Now, Europe still has some banks in certain countries that could have problems, but we'll have a different type of crisis. We'll have emerging markets and Asian flu again. It'll look more like '98. But it'll create bear markets. It'll create volatility in the markets. No question about it.
Many of the experts I've talked to say because of quantitative easing, when this correction does take place, it'll be worse than 2008 and 9, which was one of the very worst recessions ever.
That's hard to say. It's not going to be good. It will be different, and different people will have. Will be positioned differently. So, but it's not going to be good for the average person, in any event, no matter how it plays out.
So, when you say the average person, is that going to mean another wave of layoffs, unemployment, lack of industrial production, this side of the ocean?
Yes. Yeah. That's what happens when you have a recession. By definition, they're deflationary. By definition, employment goes up. We haven't, our growth, the numbers came in yesterday, was 2.8% for the U.S., but 0.8 of that was inventory build. Well, that's not sustainable. Consumer spending was the lowest it's been in 5 years, growth. So we're going to get a payback from, this. So next quarter will probably come in at, a 2% number, 1.5 to 2, because that's roughly where we're growing, is in that 2% range. Well, that's stall speed. In the U.S., next year we're going to start seeing the effects of Obamacare. It's unclear how that's going to translate into the overall economy. When we start trying to reduce spending, which, by the way, we should reduce spending on healthcare in the U.S., but that transition, when you go to a healthcare system and say, okay, over the next 4 years, we're going to take 25% of your top line revenue away. Well, that's consumer spending, and it does, in fact, go up. So an economist will say, well, in the macro sense, it doesn't really do anything because people aren't spending it on healthcare. Now they're going to spend it on entertainment or cars or new carpet or whatever. Well, that's true. But I put a real big asterisk. The transition, while all those healthcare workers are either going to see their pay reduced or they're going to be laid off, they're going to have to become more efficient. Those people are out of work for a short period of time. They have less money. And over several years, it all washes out and we'll be better off for being more efficient. But the transition could be really difficult for the U.S. We could see a definite slowing of the economy.
I find it interesting that companies always react to, a slowing economy, less revenue, by laying off workers and the ones they keep cutting their salaries, and then they wonder, where have all the customers gone? I mean, don't
Well,
they realize
I mean,
they're all responsible for it?
Well, no, they're responsible for their own bottom line. They can't just as I don't want one central bank being responsible for the entire economy. I don't want one business saying, okay, I've got 50 employees and maybe I only should have 45, given what's happening in the economy. I don't want them losing money or going into deficit because they feel somehow responsible for the entire economy.
But it does add up.
That's part. It does add up, but that's part of the free market. I mean, but that's part of the normal business cycle right now with code red monetary policies, and that. I'll get a quick plug in here. My latest book is called Code Red. It's just been out for a week, and it's on the havoc that central banks are playing. It's on the coming currency wars. That's going to be how many of the countries try to solve their problems.
Well, I've noticed right now it seems to be a battle to the bottom to see who can devalue their currency the most. And John, we'll touch on that subject once again. We have to take a break. More with John Mauldin next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're talking to John Mauldin, chairman of Mauldin Economics. He has a brand new book out called Code Red. And you were saying it's all about how we're going to be in currency wars. We just mentioned right now, Japan, everybody seems to be trying to devalue their currency so their products become more attractive. But everybody's engaged in the same battle at the same time, doing the same thing. How is this going to wash out?
Well, I mean, the old line is everybody can't export their way out of a crisis. Somebody's got to buy. And that's been the essential problem in Europe. The Germans are exporting, and the southern peripheral countries were buying, and they were running deficits in the 10% range. Then things got out of whack, and they had to rebalance and reshuffle. That's why we have part of the European crisis. That's why you have the Greek crisis. They were running major deficits, and you just can't do that. So the world has that same type of imbalance right now. In absolute terms, Germany's running a bigger trade surplus than China is. Who knew? Germany is as much a problem in the trade balance world, but they can't really foster a weaker currency. And if the euro were to have a breakup or a problem, the German currency would become very strong. It would be very debilitating to their economy. The Japanese have said we owe 250% of our GDP. We can't pay that, so what we're going to do is print it. And so their goal is now to export their deflation, and they're going to see the yen. I mean, it's already gone from 78 to 100 against the dollar. It's going to 120, then 150, then 200. For the Japanese, that's only halfway back. They look at it, 40 years ago, they were at 357, and they had to become ever more competitive all the way down to 78. And they're just saying, well, now we're just recovering what we lost. And furthermore, by printing money, we're only doing what Bernanke and Krugman and central banks around the world have told us to do. We're in a deflationary debt liquidity trap, so you told us to print money, so that's what we're going to do. And when that's going to make it very difficult for the rest of Asia to compete against them, and the yield to each of those countries responding by trying to, print money in one form or another. So
it really is a race to the bottom.
It is a race to the bottom, but everybody's currency can't get weaker. Somebody's currency's got to get stronger. The English are very determined to make their currency weaker. The Brazilians were complaining about the strong real. Somebody's currency's got to get stronger. Somebody's got to be the buyer. And until we can, get countries to stop using their currencies to try to benefit their local businesses, and just let the natural ebb and flow of trade be the determining factor, which is going to be a long time, by the way. I'm not holding my breath for central banks around the world, companies and businesses around the world to all become suddenly free market. They're all free trade as long as they get to sell into your country. They get more protectionist when it talks about their own internal work.
Canada's government says it plans to have a balanced budget next year. Does that make Canada unique among all these industrial nations?
I think Canada is one of the shining standout lights. I mean, I don't know that I'd want to, jump up to Vancouver and buy a house right now. But that being said, your banks are in better shape. A balanced budget is only going to make your currency stronger. I mean, I remember 5, 6, 7 years ago, I forget what the loonie went down to, but
about
it was,
62 cents.
I was sick to say I was trying to remember whether it was 63, but it's 62. Okay.
Close
and
enough.
I remember I was traveling around Canada and doing some speaking when it was about 65 cents. And I said, the day will come when the Canadian dollar will be at parity with the U.S. dollar. This is like in 2005. And the crowd literally laughed at me. I mean, they laughed. And I just said, okay, guys, just remember, I said it here. Because first of all, these things do ebb and flow. And the Canadian dollar was just stupid weak. And you had a crisis. You'd come through it. A balanced budget, in Canada would be a remarkable thing and a great example to the rest of the world.
And of course, governments say, well, there are so many important programs that we run. These cuts by our federal government have been very painful. They closed the Kitsilano Coast Guard base in Vancouver, which was the busiest Coast Guard base in Canada. But they said we have to make tough choices. And so if you want a balanced budget, those are the kinds of things we have to do.
Well, I mean, in the U.S., we're going to have to figure out how to make some very, very tough choices about our entitlement programs. We owe something like $200 trillion. If you believe some people, it's $120 trillion. If you believe others, it doesn't make any difference what the number is. It's a stupid number and we can't pay it. And when that crunch happens sometime in the next 5 to 7 years, we're going to be forced to make massive cuts and probably tax increases at the same time. The decision in the U.S. is we have to decide what type of health care we want and how do we want to pay for it. And that's the big political fight of this decade. So, I applaud Canada for making the tough choices now. And maybe I can use them as an example when I talk to my fellow Americans and say, hey, here's a country that can not only get their immigration policy right, but they can get their spending policies right.
And we also have government health care. My family, we pay $120 a month for our premiums. And when I talk to my American colleagues, they say $120 a month, you cover an entire family? Yes.
Yeah, mine's closer to $1,200, I think.
My goodness. Yeah, we don't understand that at all.
Oh, I don't either.
Here in British Columbia, we have the second highest life expectancy in the world, yet the U.S. spends the most money on health care, and they're 22nd when it comes to life expectancy.
I totally get that. I'm not arguing that we have a functional healthcare system. It's totally dysfunctional. We have the worst of both worlds. We try to have government controls, and we allow oligopolies and monopolies in the forms of insurance companies and big pharma and hospitals. We use neither price nor quantity as a way to set controls and cost on healthcare. It's a totally insane system.
Well, what's going to happen when this crash happens? Somebody told me the U.S. currency is going to be close to useless, and you're going to have to rely on gold.
No, I don't think so. The U.S. currency can be used to buy $50 or $60 trillion worth of physical hard assets called real estate, businesses, income producing, fixed income, all sorts of stuff. So the dollar is going to be a valuable entity. I actually am quite bullish on the dollar vis-a-vis the world. I wouldn't want to diversify. If I was a Canadian, I wouldn't want to diversify into the U.S. dollar necessarily. I'd want to be short the yen. I'd want to be short the euro against the Canadian dollar. But the U.S. dollar in general is going to get stronger. Now, if we don't deal with our deficits when our crisis comes, then yeah, we'll have a problem. But remember, let's go back to 1993. You guys hit the wall. Absolutely hit the wall. You had to restructure everything. Now your currency's strong, but your currency didn't go to zero. You're not Argentina. The United States is not Argentina. Your currency will be worth something, but it will fluctuate.
John, always a pleasure chatting with you. A great insight here. We've had all these people kind of, hitting the panic button. You're saying it's not a panic button, not yet. And even if it is hit, it's not total disaster, but it's not going to be pleasant either.
No, it won't be.
Thanks a lot for chatting with us.
Thank you, sir.
I'd like people again to take a look for your new book, Code Red, the havoc that, the currency wars are going to play over the next few years. So check that out. And John, is there a website people can go to check out your philosophies and what you think is going to happen?
You can go to Mauldin Economics. I write basically 2 free letters a week. At Thoughts from the Frontline is my weekend letter, and I'll do an outside the box where I focus on someone else's work. They're free, and you can join my 1 million closest friends.
Well, thank you. I hope I'm one of them.
Okay, thank you, sir.
After the break, John Kaiser on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is John Kaiser, founder of Kaiser Research Online. Welcome to the show, John.
Jim, it's great to be on your show.
It looks like there's a lot of concern still here. I know here in the West about the shape of the TXSX venture exchange, which really is so necessary in finding the natural resources Canada is so proud of and that we need for our economy. John, what are the major concerns about the venture exchange?
Well, we are completing the 3rd year of a bear market, which qualifies as amongst the worst in decades for this sector. And what's frightening this time around is that there are structural changes in the industry which may mean that a cyclical recovery may not be possible for this Canadian institution, even if and when, say, gold gets back over $1,500 and super cycle type conditions start pushing base metal prices up in general.
I know a lot of people who work on the exchange and with it are saying that over-regulation and overpricing are going to kill it.
That's part of the problem, and I think the exchange correctly points out that that's not an issue when conditions are good and money's flowing into the treasuries. But the problem is money's not pouring into the treasuries and fueling these companies to keep them going.
Well, how could we change that?
Well, one thing we cannot change is the shift in the brokerage industry away from taking orders from clients, giving suggestions to clients. They're shifting away to asset management, where they just profile the customer and then park their assets in various structured products and then collect their 2% fee and whatever 20% participation in the return on that account. This is leaving the whole role of doing private placement financing in an ever-shrinking pool of independent brokers who themselves are finding their hands really tied in their ability to put clients into not just private placements, but even stocks because of all these new rules with regard to, well, what is your profile? Are you over 65 and not really eligible to make decisions that are high risk and so on. So I think the simplest thing is that the $1 million threshold that makes you an accredited investor, and this does not include your real estate, your primary real estate, this must be substantially lowered, perhaps even eliminated, and just let if you don't meet this threshold, maybe you're only allowed to put so much money into a corporate treasury directly. So cut out the brokers, except the independent guys who will want to do the bigger financings, and let individual retail investors put money much more easily directly into corporate treasuries through private placements. That's what's needed to keep these companies alive until general market conditions improve.
Right now, the rules wouldn't let somebody like Jimmy Pattison trade, would they? He's over 65.
Well, he can go and open a discount brokerage account and just input his orders and do whatever he pleases. But the so-called expert is now having his hands tied with regard to letting this client place orders through the so-called expert broker.
When I spoke to Federal Industry Minister James Moore, he said he was aware of the problems the venture exchange was having, but has he done anything?
There's not much the exchange can do. I mean, people say they might want to drop their fees a bit, and they can do that. That might be a temporary issue. Some of the problems that they're not responsible for are, one, the multiple order execution platforms. They are not consolidated on a first-come, first-served basis, so that the expectation that if you're first in line, because you put your order in first and you should get the fill first, that's not being honored by the system. And that comes from the upstairs securities regulators, because they say there needs to be competition for the TSX Venture Exchange through these other entities. And this actually allows computerized front-running, what I thought we got rid of, what used to be prevalent on the old trading floor and the trading desk days. When we got computerized order execution, this was supposed to have vanished. It actually is happening again because the brokerage firm has to analyze which of these order platforms to route your order through, and there's this instant of time while they compute this that others sniff out the order and front run, just like they do in the United States in the bigger market.
Once this happens, what happens to your investment?
Well, you think that you're getting a fill either by selling something or buying something, and then you find out, no, somebody else scooped the bid or the ask. So that frustrates people. They don't think they have a fair system, so they just go away. Another problem is the elimination of the uptick rule, which prevents somebody from selling stock they don't own at any price even lower than the previous order. And so this, with computerized trading, this has created a new culture where professional traders just sit there and watch for the retail investors' money flow into the system, and they intercept it by selling stock they don't own through these day trading accounts that the stock exchange actually sanctions, and they don't have to borrow the stock so long as they're flat by the end of the day. So literally, they set up a system to harvest capital that comes in, and this makes price discovery very difficult, and it's especially harmful for the juniors. You know, they put out some good news release, and you expect the stock to go up and maybe stay up and allow them to finance at that price to continue work. Well, stock that isn't owned by anybody gets sold, and then to make sure that the longs sell, they lead into the order book, fill all the bids, cascade the longs into selling, cover their shorts, and the company's down lower than it started after putting out good news.
Wow. So it keeps people from even publicizing positive things.
That's right. We see now a lot of what are obviously maybe not off the scale barn burner type results, but they should make the stock go up. They reduce the risk of failure. They make the potential for success more clear. There's a little bit of a blip, and then boom, down she goes. So the companies are now trapped in a dilution death spiral where they have to keep funding at ever lower prices. which of course scares everybody away, because if you're funding a company in the early stage when they just have a drill target, and then they finally hit something, and then the stock goes lower, and for follow-up work, others now get in cheaper than you did when you had the higher risk, that undermines the whole concept of a high-risk venture capital market.
Well, the whole idea of a stock market of any kind is to raise money for that particular company, isn't it?
Yes, and reward the investors when the risk they took actually results in fundamental progress being made. But the whole thing is skewed against this now happening. And until we get back into a roaring narrative such as gold back at $2,000 or something like that, where everybody just wants to be in it, it's very difficult to see how this resource sector continues to thrive as a venture capital market.
What would happen if the venture exchange collapsed and disappeared?
Well, it's not going to collapse and disappear. It's more likely going to wither away. I cover about 1,800 resource sector companies, and 816 of them have less than $200,000 working capital left. That's barely enough money to stay listed for a year while doing absolutely nothing. Now, the big crunch is going to come next March, April, when the audits for the year ends come due. Half the companies have a December 31st year end. They were able to survive this year's year end because the accountants extended credit. They said, you pay us when you have the money. Well, nobody is able to raise any money. Stocks keep getting cheaper. They do a 10-for-1 rollback, go from 2 cents to 20 cents, then they're back at 7 cents in no time. An auditor cannot audit financials if he or she is a creditor to the company. So they're either going to have to forgive the debt and run up a new debt and hope that the cyclical turnaround predicted by the stock exchange happens, or they're going to have to say cash up front, pay off these old debts, which means the companies are going to have to reach into their own pockets and buy more paper from their own company with no real aftermarket available. So there's about 300 companies that have no money left. They owe about $1.5 billion that comes due March, April. So that's when the crunch happens. Stocks will be suspended. They won't file financials. Companies will simply walk away.
Wow, just like the mortgage defaults in the U.S.
Yes. And it's not such a bad thing, because there are still 800 companies that have money left, which are being very careful right now, which have managements which are not the pretend kind, who are only going through the motions of looking for an exploration deposit or future mine. These are the ones that we should be focusing on. And frankly, when these other 800 companies are gone, the playing field will be far less cluttered, and when retail investors come back, there's a lot less chaff to sift through in order to investigate the wheat and see which ones you want to place your bets on.
Right. So again, 1,800 companies and maybe 800 will come out of this?
Actually, 800 are at risk of disappearing. Maybe 1,000 of them survive.
We'll have more with John Kaiser next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser, the founder of Kaiser Research Online. John, where are we in the cycle that's driving this bear market in minerals?
Well, the big engine during the last decade was the super cycle, which was China coming on stream with a major build-out of infrastructure and productive capacity, which sucked up a lot more raw materials than the mining industry had grown accustomed to supplying. So that gave us substantial real price increases, copper going from 60 cents to $4 before stabilizing at $3.25. And we've even seen gold go from as low as $260, touching $1,900, and now it's back at $1,300. Now, the super cycle has been declared dead by many parts because China's slowdown is growing. The Great Recession created by the financial crisis has yet to be resolved in countries like the United States, which are still limping along with a dysfunctional Washington creating policies that aren't really conducive to growing the economy. And Europe is still mired in a very weak economy, with Germany having set up a structure whereby it is building up big export surpluses, which benefit Germany but do not benefit the Eurozone or other parts of the world. So this has resulted in the metal prices retreating somewhat, and this has caused people to say, okay, super cycle is over. We've had the mine supply response. The growth from here on is not going to be substantial, so you're going to have to focus on projects that are profitable at these levels. And that's where another problem kicks in.
And what problem is that?
Well, the horror that everybody discovered in the last 18 months was that we have seen in the mining sector horrible cost escalation, both in capital costs and in operating costs, and in the big chunks that the governments want from these mines. They see these much higher prices, and they think everything is now in super windfall territory. So we've heard some figures say it's been 10% a year, which translates in the last 5 years, that translates into a 60% increase in costs. So the real stock price, the real metal price gains that we saw in the last decade have to a large degree been clawed back, so that, when your project that didn't work at $500 gold, that should work fabulously here at $1,300 gold, well, now they're discovering that the all-in average cost around the world is $1,200 an ounce. So even though we've had this phenomenal gain in the price of these metals, that's just a nominal figure. The profit margin is back to where it was a decade ago. And that is why companies are discovering, oh my gosh, we way overpaid, and our capital costs are way higher. We have to shut these things down. We have to get rid of these things. And ironically, we are sowing the seeds for the eventual resumption of the supercycle dynamic, because this typical mining industry's response to this boom-bust cycle, even when it's done within a supercycle context, sets the groundwork for shortfalls down the road when global economies do finally get back on track again.
And what kind of a shortfall would that be? Because so many mining operations had to cut down or just close, there isn't going to be enough product to really fund or fuel this thing?
Well, all these in the junior sector, we had over 200 companies taken over in the last decade with a value of about $130 billion. That's absolutely phenomenal when you consider what happened in the junior sectors in the 80s and 90s, where you had maybe $10 billion in takeover bids from things like the Hemlo discovery, the Eskay Creek discovery, the Caddy Diamet discovery, Voisey's Bay, and a few other things like Perina, which were all discovery-driven type buyouts. So all this stuff, which most of it had been found in prior decades through earlier exploration cycles and discarded as it didn't work. It's the grade's not quite high enough. The costs are too high. But when we had those real gains suddenly come upon us, and the mining industry suddenly understood the super cycle logic, they said these things are valuable. And of course, the juniors, whose exploration teams used to be employed by the big companies before they got fired during the 1997 to 2002 bear market, they grabbed all these projects, and the institutions came in and they could crunch the numbers, and they gave them, $50-60 billion to demonstrate that these projects worked. And the big guys, the big mining companies, they bought these assets that the juniors recovered from the woodwork, dressed up, and then the big guys started pouring in the money to put them into production. And a lot of these are now being mothballed. They're not going to go into production because the costs are too high, and the big supply glut that we were expecting to kill metals like copper, that's not going to happen in the way that the normal thinking would have projected.
One of the mining analysts for the Morgan Report told me something that people who are in the mineral market should be aware of is that 3 or 4 of the world's biggest zinc mines are about to close over the next 3 years, and nothing big is there to take their place. Is it because people are scared to explore, or there's just nothing out there?
Well, the bull in the China shop, pardon the pun, is China. China is the biggest zinc producer, and they don't produce it from a handful of very giant mines like happens in the rest of the world. They produce it from an awful lot of small to medium-sized mines, and these mines produce with virtually non-existent environmental emission controls, some of them illegally. And so China's ability to keep supplying this while not getting a riot on its hands from unhappy downstream people suffering all the consequences, I think is very muted. So on top of all these Western mines shutting down, I think we're going to see, at the very minimum, a stoppage of growth in Chinese supply and probably even a decline. And a reason that there hasn't been a lot of zinc produced is because everybody has looked at China and say, they can just keep pouring more and more zinc on the market, so what's the point? And so we now do have a gap where demand in the next year or so is expected to exceed shortfall, a shortfall being created by a depleting mines and nothing to replace them. And this is different from copper, where we can see plenty of copper coming on stream until about 2017, at which point, if money isn't invested now on greenfields exploration, we will start seeing a shortfall redevelop for copper, and we'll have a copper boom at that time. And of course, the sad thing about this current bear market is that people see the flatness of the copper price, and the 4 years is an eternity in a resource junior's life cycle. So the capital isn't going into exploration, and I think it should go into exploration right now. And that's why it's unfortunate that the retail investor has become alienated from this entire sector through some of these structural problems that I described earlier.
I was just going to say, this all comes back to what the venture exchange does best, and that's to encourage the search for new minerals, new resources for us to go after. And whether you believe in climate change or not, I saw a report that said the one country that's going to benefit the most from it is Canada, because it's going to, as the ice disappears, it's going to uncover mineral resources and other things that we didn't know about.
Well, Greenland's one that's going to be probably the treasure trove that gets unearthed the most. Canada stands to benefit because so much of the northern part that cannot be used for agriculture is going to end up becoming very arable and the future supply of crops for the rest of the world.
John, Thank you very much for chatting with us. Is there a website somebody could go to find out more about your philosophy on mining and minerals?
Yes, it's KaiserBottomfish.com, and on the homepage you'll find a couple of links that are unrestricted. One which called the Gold Resource Center, where you can find out my whole idea of what will drive the price of gold in the future, and also a link showing you some of these statistics relating that describe how difficult the situation is for the resource juniors right now.
Thanks a lot for chatting with us.
Thank you, Jim.
Thanks to our guests, John Mauldin and John Kaiser. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.